Another week of not much progress in the NASDAQ front, but what we saw today was utilities. We mentioned utilities a few weeks ago on um, we were our system was telling us that we're entering into a slowdown regime, which is very beneficial for utilities, healthcare, um, could sometimes bonds in certain situations, but it depends on the trend. Utilities out of those three is the only one that's been bullish trend, which just recently went neutral. But we're seeing it move now, and this is giving me conviction in the slowdown trade. Like the NASDAQ was red today, but utilities skyrocketed.
Yeah, so obviously there's some situation going on here or a condition that we have to accept where as we head into Q1, um I think that the market's pretty much priced or positioned for a possible wave of incoming tariffs, and we've seen the market sell off somewhat on a lot of this tariff headlines and stuff like that of that sort. And ultimately bond yields are higher, dollars higher, all signaling possibility of tariff induced price hiking and stuff like that of shocks coming into the market. And again, you have the Trump fiscal plan, which hasn't had a lot of real life experience, real life time in the economy, right? Like we haven't cut the taxes yet. We haven't seen what the tariffs will do to the deficit. So there's that upfront shock that I think hit the market and risk over the last couple of weeks. And then what we had here recently is some slight altering of tariff strategies, possibly looking at gradual tariff hikes and stuff like that. Initially, that was risk positive and yield negative, but ultimately CPI was what sent the risk up and yields down. And I think if we look at it from a perspective of what happened with CPI on Wednesday, we had yields drop, long bonds pop, utilities popped as well, risk popped as well. Everything pretty much was up. And this, I think, when you look at it like this, man, you have to break it down into what is going on with bond yields right now. So if we take a look at the long end, right? Oh, sorry, long end. We're in a position where I think um, the yields are. I don't want to say they've peaked because I feel like I'll just jinx it, right? If I say this was the top,
Yeah,
but
it's really only been a couple of days.
I do think that the way this is going to work and what we've seen so far is about so far accurate. Is this? I think that wherever yields pop and they fall, they're going to provide this cushion of positive reinforcement for risk assets or all assets. It's going to be all asset positive, right? Because yields falling from 5 to 4.5, in my opinion, are not going to be so much recessionary. I think you're going to just see a reversion of this rapid pricing since the election that we saw get pretty much juiced into the election was here, right? So ever since the election, sorry, the election was here. So ever since the election, we've pretty much gone up. A little bit of a dip, but up only for the rest of it. So I think that a lot of this Trump talk and Trump tariff stuff, if there's any sort of like relief there, that's going to be somewhat risk positive, at least for the first, call it 50 basis points from 5% down to 4.5%, because you're not essentially this is not the stage where the bonds price in a recession. This is the stage where the bonds get scared about inflation, and just taking that inflation scare off the table is not necessarily recessionary risk, right? Again, slowdowns themselves aren't recessionary in terms of growth, but this type of action in bonds is around fiscal slash inflation in inflation fears. It's not up because the market's pricing an absolutely zero case of recession, and it's not down, obviously. And if it were to be down, I think from here, the first move would be the evisceration of inflation fears, which is going to be almost everything positive in risk.
Yeah.
And then once you break that like 4.5% mark or whatnot in that range, call it, there's no exact point, but you break this zone 4.5 to 4.25, you get down into that area. I think the market starts just automatically pivoting more away from that slowdown slash choppy growth environment to where where the market starts anticipating that there could be some actual recessionary fears.
Yeah. I hope we get out of this trend that we've been seeing over the last few weeks. It's really been reminding me of the 2022 stagflation era where you're seeing the dollar move higher, you're seeing commodities move higher as well. Um, Stocks flatlining, like pretty much just chopping around. I'm really hoping we don't enter into another situation like that. Inflation really needs to get out of control again, and I think that's what the market was anticipating over these last few weeks, pulling out
Yeah, I mean,
those rate cuts from the market just because of that fear. I bet you I'm not the only one that's shell shocked from 2022. I think as soon as the market starts picking up that possibility once again, it starts to price that in.
yeah, I mean, I would say this much, right? So this isn't updated here. We don't have for some reason, trading view isn't updated. Just beware when you're looking at this chart. We haven't gotten the December figure on here. I'm not quite sure. But ultimately, based on what you were saying already, yeah, like inflation on like down in these trenches, you could say, I am not thinking 2022.
Yeah, I think the market is just so scared that any slight indication, it starts to think back at that, and it's like, okay, what is going to happen? The same thing's going to happen. Stronger dollar, stocks are not good, bonds are not good, and I think that's exactly what we've been seeing over the last few weeks until just the last 2 days. I'm really hoping that this is a vibe shift that we're seeing right now.
Well, just look at it like this, right? From a perspective of the implied cycle, which is roughly 2 years, if you look at it from the on a Fed cutting or hiking cycle versus the Fed funds rate. Where we were in September was like way discounted from this. So look at it from where we were at the Fed funds level. We were at 4.8, and the 2 year was down at 3.5, indicating like there were a lot of cuts coming, right? Basically, in layman's terms. And since then, we got the continued rate cuts, but this bounced hard, and now we're pretty much sitting 10 basis points below the Fed funds rate over the next 2 years, implying that there is not much of a significant delta in the Fed funds policy path over the next 2 years.
Yeah, which that just doesn't make sense either. That is way too pessimistic in my opinion.
Well, I think it's important to look at it like this, right? The Fed's cut nearly 100 the Fed's cut 100 basis points. Bond yields on the front end, which are more mimicky or more symmetrical to where the Fed's policy path is going, have lifted, right? And we're at a point where we took a lot of cuts out of the market the last 2 months. And a lot of that is on the back of, again, what we've been seeing with um, the unemployment rate not really accelerating, to not really breaking up as it was kind of looking like it would, but more importantly, like this whole shift around the incoming administration and their fiscal impact. And I think that is where the market got shocked or what the market got shocked with. And it wasn't so much, oh yeah, inflation's going to reaccelerate, but it's more so like the uncertainty about what the tariffs will bring, which you could argue in a sense is inflation, but it's not so much like, oh, inflation's going to riproar 9%. It's more of like these tariffs will slow the Fed's policy path down because the Fed will not be able to bring rates lower because inflation is going to get like basically anchored into this range as prices go, as tariffs impact prices on certain goods, pushing prices up here and pushing prices up there, et cetera, right? So it just slows down that disinflation, disinflationary trend in force. Therefore, the Fed is going to have to put the brakes. Therefore, rates on the curve get yanked up like we're seeing here on the 2-year. And that's pretty much what we've been seeing the last couple of months in the market. But I don't think that the end result here is going to be higher inflation. I think that this is an inflationary shock that the market's going to absorb, and pretty much it's going to wither away. I do think we see more cuts come onto the table here. I'm in the camp, and I think we've been pretty vocal about this. We're both in the camp, right? That the highest risk, or the largest risk, right, the greatest risk right now, I should say, is a slowdown in the economy, not a recession, a Q1 slowdown. That's what I think is likely the scenario here.
Yeah, and I think that's why we're seeing utilities move the way they're moving, because I think the market is picking up on that as well.
The importance of these pivots lie in the fact that there's some confusion when we have tickers that approach trend shifts, specifically like IWM scenario, right? IWM is floating around Momo, and we don't really know where. We don't really know at what point up until we put these labels on the chart for everyone. It was hard to distinguish where exactly the trends would shift. So you would just see IWM falling maybe through Momo, and then boom, neutral. And then if it really got slammed, you would get the bearish. But you wouldn't really know at what pivot points things break in either direction. And I think these flags basically allow us and our followers to just understand the context of where we're moving a lot better. So you basically don't get in a situation where you kind of are up in the air all day long, just praying to God the candle doesn't close in a bearish trend or a neutral trend. You kind of understand, okay, if the price is, if the pivot point's estimated to be like 216 for neutral and we're at 215, as long as we're under 217 or whatever the pivot point is, like we're gonna flip neutral.
Yeah.
That's how like this is supposed to really help and guide us and give us more confidence as the day progresses as to what we can be looking towards into the close.
It pretty much just gives like more of a heads up. Like I remember with XLU, we went long for like a day or two. And that day that it went neutral, it was fluctuating between neutral and bullish. And we didn't have visibility in that. So this would pretty much give us visibility into that. We would see, okay, this is the level. Once it passes that level, it's neutral. It's easy to see as it happens in real time. So
Yeah,
I think that's a great
exactly.
ad. That was a very good ad. I don't know if anybody asked for this, but you guys have it now.
Nah, I figured, our members and us, we both I guess you and I, and then our members as well, have been through a lot with like the system trade, all these like trades the last couple of years. And whenever there's a pivot or whenever there's a trade day, everyone's antsy. They're like wondering, oh man, is this like, are we gonna switch today? Are we gonna switch today? And I think this is just a real like kind of like relaxing way for everyone to kind of just sit back and just watch it happen without having to like wonder, oh man, like we're holding on, we're flipping, like where is the pivot point? I'm scared. Like, you know what I'm saying? Like you could just be like, all right, here it is. If we flip it, we flip it. If not, on to the next.
Yeah. And now it's funny, like it gives you a heads up, but now I'm like, oh, like what about tomorrow? I want to see where that bullish trend flip is going to be at tomorrow. Can we get like a heads up for what's happening tomorrow too?
No. It's only there to show you where we have to move today. Reason why we don't show what we have to do tomorrow is because there's a lot of fluctuation that goes into the calculations, and we want the nearest point of delivery. But if we go forward, we have to start forecasting values, and like that is not that's just going to be too messy. It'll be too unpredictable. So by us having the daily values, we kind of have a anchor point. At least now everyone has some clarity and context of what's going on. But if we start forecasting, it's going to become pretty wild, and like people are going to. I have a feeling, man, it'll just annoy people because you're going to think like, oh, there's no way we're going to flip today, and then something wild happens, and you're like, oh my god, I was not prepared.
Yeah, definitely.
Yeah. So I feel like that clarity is good there. And then speaking of slowdowns, right? Because we were talking about that earlier. I think that a lot of people just misunderstand what a slowdown is. We keep saying slowdowns aren't recessions, but I think like the big miscommunication with that is like when they hear slowdown, they think like, oh, it's just down. They hear the word slow and the word down, and just like it can't be good. And like quite honestly, there's a lot of there's many slowdown periods in our back tests where like the NASDAQ does go up. Risk assets do go up. I mean, one of the assets we hold Bitcoin in a slowdown. And like you could argue, well, like that doesn't make any sense. Well, the reason is like Bitcoin is somewhat weirdly asymmetrical with the slowdowns. Like if it's in a bullish trend, it does pretty well, oddly enough, in slowdowns. But if it's in a bearish trend in a slowdown, it gets absolutely destroyed. So one of those weird things that you just kind of have to like lock in on the trend. And as long as we're not in a risk off, like hard risk off or / recession, just stay locked in type of thing, right? And risk assets, they go up too. It's just a weird thing where like it depends where you're slowing down from. I think that's the big line in the sand, man. Like look at it like this. If we're slowing down from 3% growth to 2.5% growth, or for 2.5% growth to 1.5% growth, it's completely different than slowing down from 2% growth to 0, right?
Yeah.
We're not negative growth, but we're like the slowdown context matters. And I think that's what really differentiates the driving factors of risk in these different slowdown regimes, in these micro slowdown regimes that we experience. Ultimately, I think that's why having that that combo Bitcoin / possible utility healthcare bond exposure, that we're like we could be long those 4 assets all at the same time.
Yeah.
As crazy as that sounds,
Yeah.
but it just makes sense.
I think the one area that we might possibly be lacking with Aries is commodities exposure. Like, what happens if we get into some sort of regime where everything is kind of chopping sideways, not really moving too much, but commodities are where you want to be? That's kind of like what
That's
2022 was a little bit.
That's a good statement. I think that ultimately though, you're not gonna like this, but I think ultimately, man, commodities are garbage.
Yeah, they're garbage most of the
I
time. I agree.
they're garbage. They're garbage. And I'll tell you why. So commodities have this weird, I think it has something to do with the old. It's more of a conservative. I'm not talking politics. I'm talking more about a financially conservative approach, right? Where people love the idea of owning hard assets, things that are like, oh, like platinum, right? Like these rare metals that are like because they're very easy to break down and understand,
Yeah, it's like
right?
you
They're very
gotta mine it. There's a finite amount. Those are always the
right.
arguments to hold
And
it.
people love the idea that like there's a scarcity function to these commodities, that there isn't really a there's no such scarcity function to like Apple stock, right? And tech. So they look at it like, okay, the commodities are finite supply, and there's always a super cycle coming with these commodity traders. There's always a super cycle coming. And back in 2020, earlier in 2024, I really noticed that when we started seeing this move up here in Q1, like this move here in commodities, there was a bunch of funds on the internet, on X, and they were like really heavily positioned for this commodities like resurgence, which we're slightly seeing now a year later, but like they were all positioned for this super cycle. And I think that that's where the error is in this whole thing, because look, I think commodities trade in this point where like they'll do like this mega move from 2020 to 2022, where again there was a lot of like supply chain disruptions. There was a lot of factors there juicing that. But ultimately, I think commodities trade sideways to down, because everyone likes to talk about scarcity, but at the end of the day, it's a product where the stuff that we might be using more vehicles, we might be using more, for gasoline, we might be using more precious metals, but I think that there's a ton of optimization to be had in how these materials are retrieved, and that optimization and that increase in efficiency kind of offsets some of the scarcity function of what these commodities are. Like that's like the macro take on commodities, but the technical take on commodities is they trade like shit. They just trade like shit. And to put your portfolio with leverage on them when like we could get a headline out of the Middle East that sends oil like that just absolutely nukes oil, it's dangerous in my
Yeah.
opinion.
Yeah.
Just dangerous.
I'm curious, like, how many moments since 1991, like where a back test on Aries started, how many moments did commodities actually outperform whatever else we were holding at the moment? Like, usually I would assume it would be like cash periods, kind of like what we saw in 2022. Like, instead of cash, if we were holding commodities during those periods, would that even really make much of a difference? Or would it just add volatility to the portfolio?
I mean, we've certainly tested commodities as a holding factor many, many times in
Yeah.
in the
We
process.
could
But the
not
problem,
find something that
yeah,
worked. We've
it
tried a lot of
literally,
different things.
I don't know how to say this. It's literally uninvestable. Okay, just uninvestable. I
Yeah.
think just look at it from a perspective like this. I have DBC, the Commodities Tracking Fund, up on my screen, and I have it with the dividends adjusted, meaning like any type of like ETF or basically any dividend from the fund, whatever from positive roll value, whatever it is, has been accounted for here. Commodities index as a whole is no higher than 2010, is no higher than 2007, is no higher than 2014 right now. This thing does not, commodities are not inflation hedges for the most part. Again, because we have an immense amount of ability that's understated by commodity investors to improve, optimize, and expand the collection of said commodities, right? Like this idea of scarcity, we can find more, we can improve what we're doing to yield more, etc. Right? So the supply is not as finite as everyone wants to make it seem. And if the supply was actually so finite, it was so rare, and the demand was ever so growing, the price would be higher.
Yeah.
Now people will say like, "Oh, but like you don't know like the the inventories are falling, right? The IA inventories or whatever it is, like the our production's just falling off a cliff." They're getting if you're talking about oil, they're getting oil from somewhere. It's happening. Your chart just doesn't show it, but you know what does show it? The price of oil, right? If we take a look at oil, like to say like oil is like a scarcity or a scarce object, and it's just or a scarce commodity, and like we don't have enough supply. Like we can just look at it from a price perspective, and I can promise you, like oil is the same price it was in 2010.
Yeah.
Okay, so if our consumption has gone up so much and the scarcity is just it's just such a scarce material, then why is the price not up? If your inventories are falling and the demand is just rapidly rising, as some of these commodity bros like to say, the thing that needs to be rising to confirm that is the price. Otherwise, the demand is not actually rising.
Yeah. Like, I think there's only a handful of periods like what we saw in 2022 where commodities were the outperformer. Everything else was garbage. You didn't want to hold anything else, either cash and you just collect interest, or you hold commodities. And we
That
went with the cash option in 2022. And like, I would much rather hold cash during those moments that happen maybe every 30 years and miss out on a commodity move than to like build a whole system around it where you're longing commodities during terrible times to long commodities, which is almost always.
I literally had a tweet earlier in 2024 that I put out that said, I have a feeling that the the commodity hedge funds are not going to do well this year. And there were a couple of big funds out there that posted losses in 2024. Imagine that NAV losses in the year.
Yeah, when the S&P is up over 20% for the year.
That's crazy. And like they're stuck with their thesis is some of them don't touch tech stocks, some of them don't touch um, anything with high valuations. And that might be something that scares people. And then like, oh, dot-com bubble, you've traded through all these cycles, you're so scared, right? And all these things. But like I think you have to be very careful when you're listening to people on the internet. And even what we say, take it with a grain of salt, do your own due diligence. But like this idea that you you get anchored in these commodity plays, I think I think 2022 is the most dangerous to those that don't have the conceptual understanding to track back over time and basically just do what we did with commodities here, like looking at the price of oil over the last 10 to 15 years, looking at the price of commodities for the last 10, 15 years, realizing they've gone nowhere. But like people just see this mega run in 2020, 2021, and they see some squiggly line chart, some Bloomberg squiggly line chart with a log scale, like up arrows, like all sorts of like colorful lines saying like super cycle upon us. And they're like, oh my God, commodities are going to go to the moon. Oil's going to go to $200 a barrel. Like it's time to like, you can't run that train's a very, very old and long train. There's a lot of dead bodies in the cabins and then back that have been picked up along the way. You have to be very careful with commodities. And I think that's just one of these things that you can try and trade, but you have to kind of let the moves pass you by. I know it sounds dumb, right? Just let the moves go, don't bother. But it's one of those things where like we have a massive commodity move within the last 5 years, and the odds of us seeing a cycle like that at any point in the next 5 years is pretty low, in my opinion.
Yeah.
Pretty low.
And then investing in commodities, you're missing out on where the money actually is, which could be in the NASDAQ, could be in bonds, could be in utilities. It's just not the
Yeah,
way to go.
I mean, again, we could just do a quick comparison. NASDAQ to commodities. Like, just scroll it. Like, there's just no, like, come on. Yeah, this was the epic win in commodities in 2022 when the commodities absolutely devalued the NASDAQ. They basically increased while the NASDAQ got smoked in 2022. They've recovered. The NASDAQ has recovered. So if you bought commodities in 2020 and you sold the NASDAQ, you have gone nowhere in almost 4 years against the NASDAQ. Meaning you caught that mega move in the NASDAQ, in commodities, that rip that we were just talking about from COVID, and you gave pretty much it all back against the NASDAQ.
Which that's what's happening to all these commodity funds now. They're going to have a rough few years.
They built so much AUM, man, on such hype. It's crazy. And now they're faced with the fact that like people, it's not going to happen right away. If you post a couple years of plus 50, plus 100% gainers, people aren't going to ask questions, right? But you start having back-to-back losing years after having like this record run, and then you start having like medium up years of, even your best years are still negative alpha. They might be positive returns, but negative alpha. The questions are going to start really accelerating as to like, do you know what you're doing? Yeah. It's scary how crazy people pivot and how quick, but emotions are crazy, especially with millions of dollars. People they're ruthless. They don't care. So some of these funds we saw blow up the last couple of years, and blow up's the wrong word. Rise to like the top. I have a feeling some of them may not hold their positions. I hope they do. It's a tough business, but it's just the way it works. That's a good pod, guys. Thanks again for listening. If you have any questions, you can reach out to us on X at the Market Radar or go to our website at market-radar.com.